It's great to have your company here on Business Now. Well, in April this year, as fears about Donald Trump's tariffs and potential trade wars took hold, the Australian dollar dropped to its lowest point since the beginning of the COVID pandemic. It's a 59.15 US cents. With the global disruption, many feared our currency would continue to come under strong pressure. But as the US has recently cut new trade deals, but with fears of a US recession, the greenback has fallen and our own dollar has peaked at around 66 and a quarter US cents. You can see it's now 65.1. But where does it go to from here? Well, the man we turn to is Sean Callow, the senior foreign exchange analyst at InTouch Capital, who joins me now, one of the most experienced foreign exchange analysts in the country. Sean, where's the Aussie dollar go from here?
I think near term it might continue to struggle a little bit around that 66 cent area. I do see the case for it to rally later in the year, but it poked its head above 66 cents, and then the US dollar's just found a little bit of support in recent days. And as one of your guests mentioned, there's less recession fear in the US, so that was certainly a big factor in the Q2 fall in the US dollar, which was very dramatic, and that helped the Aussie rally. So look, it's on a bit firmer footing in the past few weeks than it has been for a while. It's got a bit of help from the RBA changing its tone a little bit on rate cuts. And we've got iron ore prices above $100. But yeah, it does worry me a bit that you can have iron ore above 100 and the Aussies failing to have another go at that 66 cent level.
Yeah, it's pretty interesting this because there's so many moving parts that go into our currency. There's the differential of interest rates with Australia compared with the rest of the world, and particularly the United States. There's quite clearly commodity prices and what our trading and our movement of capital is in and out of the country. And then there's obviously the other comparison with these other nations, which have to be also assessed by their own measures. So this is where it's judging the Australian dollar and its movement is always a very, very tricky thing.
Yeah, that's right. And when we got those tariff shocks in early April, as you mentioned, there was grave concern for the US economy, but it was that ripple effect across the world. We just weren't really sure how things would end up. We had that period where the US and China were going tit for tat in terms of hiking tariffs on each other, and it all looked really worrying for our major trading partners. So it's very difficult to pin down. There's certainly a range of opinions, plenty of dollar bears around there, which would that be bullish on the Aussie. But then again, it's the case of how does China respond? Can they produce the stimulus that would offset some of the impact of these higher tariffs that are still in place with the US? But it's certainly a more positive mood. Those rallies in global equities are usually supportive for the Aussie dollar. It does tend to correlate positively with that. So the uptrend in the Aussie is still probably the most likely path over the next few months.
Okay, so for farmers who need to know, when they need to trade their products, for anybody who's trade exposed, who's bringing goods in and out from overseas, you've given advice to these types of businesses and people for a long time. What's your own sense as to where is a good number for the Australian dollar right now to be either trading in or out of the country?
Well, I think we can be a lot more confident that we're not going to see the sort of collapse that seemed likely in early April. So I don't think people need to be concerned about another revisiting of the 50s below 60 cents. But on the other hand, I think on the top side, I can understand people who are going for 70 cents. For maybe later in the year, but I'm thinking more high 60s. So I think that's sort of the range we're probably talking about. If things globally turn a bit sour, then maybe back down to 63. But on the top side, you could probably see 68 cents later in the year. But that would be requiring the US dollar to come under some fresh pressure.
So in other words, what you're saying is if you're importing, then look for your dollar above 66, 67 to bring the goods in. You get relatively a bit of an advantage there. If you're moving goods outside of the country, then you've got to wait until it's under that 65 cent mark. But the reality is our Aussie dollar's been relatively range bound for a long period of time now.
Yeah, it has. Look, it's been so much more stable. And if you look at the trade-weighted Australian dollar, it really is broadly in the same range that it's been for several months. So that stability is interesting. I think, as you say, with all those moving pieces, you've got these potentially bullish factors supporting the Aussie, such as iron ore and maybe a more cautious RBA. But in the end, on the interest rate side, you've got the Fed famously not in a rush to cut rates again. So that leaves their benchmark interest rates higher than Australia's. So those mixed factors and the mixed opinions in terms of what to expect for China probably do mean that we don't need to worry as much as sometimes we do for the Aussie that we're going to see massive moves.
Brilliant stuff. I've got to go, Sean. I apologise. Many thanks for your time from InTouch Capital.